Well, let's talk about big tech, the good, the bad, and the ugly. We've had big tech pretty much into 2021 being the cool guy, the cool guys that just carry on going up and no matter what, just ticking up. And eventually, I think that big tech has looked at a lot of these growth stocks, a lot of small market caps, saying on, we want some of that action, and have just totally decided to join the party, and they are making moves. Some in a good way, some in a bad way, and we're going to cover 3 of them today in the last 24 hours. It's been a bit of a crazy 24 hours. Just when you think everything was calming down, it's gone a little bit crazy again. And we're going to be talking about Google, and we'll talk about PayPal, and we'll talk about Facebook, or as we should say, Meta, I guess now. And just like a 2-minute, 3-minute talk about their earnings and the moves that they made. So hope it's all useful. And it's typical. This video comes after a few of them are mentioned on the video that I did yesterday, which was talk about 10 growth stocks, and 2 of them were on this list. So yeah, we'll take a look at these. So the first one is Google. Google was probably the good one. The Google one was the well-behaved one. It was actually up 7% yesterday. And Google's earnings were not yesterday, they were the day before. So it has closed at 7% up. And Google's a fantastic company. It is fantastic. You've got a search engine there. You've got obviously YouTube on itself, which is worth at least a fair few billion, we'll put it that way. And the thing is with Google is they're putting these impressive numbers in, and it's trading at 28 times earnings. It's not like a crazy valuation, which you've got to remember. Now getting onto the actual Google earnings, like I said, absolutely fantastic. Alphabet shares, Alphabet surges 11% after Q4 earnings, beat expectations, and also a stock split. So they did announce a stock split. They did a 20-for-1 stock split. Now this is the crazy thing, is that stock splits are starting to come back into fashion. Even though a stock split generally gives no extra value to a company, they're just kind of seen as a bullish sign really, and people generally still the way the stock splits were done earlier is that we didn't really have, when I say earlier, a few years ago, is we didn't have brokers that basically offered fractional shares. So if you wanted to buy a share in Google, it was quite an expensive share to be purchasing up, and that's what, people would maybe avoid that share because, well, offer investors that have lower money, because they were like, well, I don't want to be paying that much for one share in Google. And then if you wanted to buy any more, then you've got to do it all again. So it was quite a common thing for a lot of companies to do, stock splits a while ago, but now they're coming a bit less common because of fractional shares. But for some reason, they are starting to come back in fashion, and even though it gives no extra value to the company, the stock, it still seems to give the share price a little bit of a lift. I think it's just maybe the thought of, oh, it's a cheaper share. I don't know, but so I think that topped. I think the actual earnings were taken positively, but I think because it had a stock split on top of that, that also gave it that little extra boost. Now the actual numbers were, it came in with $30 a share, which is absolutely nuts. $30.69. On revenue of 75.33 billion, and the estimates were 27 a share and 71 billion in revenue. So this was absolutely smashed the numbers out here. And the thing with Google is it's just increasing that revenue a huge amount, and the profit they're making is absolutely amazing. And the big question I have with Google really now is, they have such a strong balance sheet. They're sitting on 139 billion in cash. I don't know what they're going to start doing that. That's a very healthy cash balance. Obviously, you can buy back shares. I mean, we haven't seen the return to dividends for a long time. That could be an option. But yeah, this is just a profit machine at the moment. So Google was the good one. Now probably to the bad one, which was PayPal. PayPal, it's been a while. I say it's been a while when we're going to talk about another one in a second though. It's been a while since I've seen one of these big techs dive so much off earnings. It's been a while, there's always you go into earnings season and go, I wonder if there's going to be something that just like completely dives, and it hasn't seemed to happen for a while, and now we've got one, and that one was PayPal. So PayPal has had a horrid kind of last 12 months basically. Crazy to think we peaked out at $310 and now we are down at $132. So yeah, that is a massive fall off, 57%. And this is no small company, we're seeing a move here of 25% from a company that's valued at 155 billion. The only times you see like normally companies move this much off earnings are your companies that are like valued at, say, millions up to maybe 50 billion-ish maybe, I would maybe push it at. And then to see this at this sort of level is a massive, massive move. And I think the big thing, it's always important to say that, PayPal was a very high valuation, But looking at it now, I mean, it's dropped down to a 31p ratio. I mean, the only other day I was looking at this one and considering, I think it was up at something like a 40 something, maybe 41, 42, and going, you know what, at some point, if it carries on dropping how it's dropping, which I don't know if it will do, this comes a buy. And now we have a 25% drop off it, and it does come really interesting. Now, on PayPal's earnings, it was an interesting one because it wasn't really dropped off the numbers, it was off the guidance that PayPal gave. And without doubt, when you look at the numbers that PayPal give, we just look here. So, and if we have an actual look at the numbers here, which is Q4, if we look at the EPS, it was 111 and the estimate was 112. So the EPS was only just slightly out, which you can be fine. That's a penny out. And the revenue was actually a beat here. So the revenue was absolutely fine. So the EPS and the numbers that was in Q4 was solid for PayPal. There were nothing wrong here. It was the guidance that was a little bit weaker for PayPal, and that's what caused the drop. So the Q1 adjusted EPS was 0.87 versus 1.16 versus the consensus. So that's quite a bit of a drop off of the EPS side of it. And you see for 2022, the EPS was 4.60 to 4.75 versus 5.26, which was the consensus. So this is, like a bit of a, 10% decrease in the EPS. So obviously that's going to obviously hurt the stock. That is probably the main reason for the drop off in the share price. And they can see they're still guiding for revenue of 15-17% at current spot rates, with revenue excluding eBay, because obviously one big thing that's happening with eBay, PayPal and eBay at the moment is a few years ago they split up as a company, and now eBay has stopped using PayPal as their payment provider basically. So there's a lot of adjustment going on there in PayPal at the moment, but even with that adjustment going out, it's still a pretty solid payment company without that there. When you consider Venmo and everything like that, it has the Venmo partnership with Amazon coming in, a lot of international growth still to happen. And you can see here, it's still expected to grow 19 to 21%. So the growth rates itself is obviously still pretty good in this company. The big problem is that you had, the big drop off from the EPS side of it. So if we just had to look at the analyst expectations, for example, analysts still had this to grow, 16% this year, and on the average EPS here, you can see that it is starting to drop a little bit here. So you see current year 2022 is 4.92, and like we said, what they just guided here, which was 4.60 to 4.75. So I think these analyst updates are starting to get updated. That's why it's just dropping. I think it was a little bit higher than that yesterday. So you can see here that the revenue side of it is still pretty strong. It's just the amount of costs that are happening at the moment is what's going to hit the EPS. But the EPS was only moved down 10%. This is still growing in the right direction, and the EPS side of it. And there's still quite a good few things to look forward to in this company. So when you look at the drop off in share price yesterday, you look at those earnings and go, yeah, they were bad earnings. But I generally looked, if it was one of those where you kind of like took away like what I knew, if I didn't know it dropped 25%, if you asked me to kind of go, okay, PayPal was whatever it was, the previous close of $175, and you said, okay, these are the earnings from PayPal, what do you think it's dropped? I would have said probably, yeah, it's going to get hit. It's going to probably get hit 10%, I would say. So I'd say, maybe just below the 150 mark. And then you say 25% down. And then you're like, oh, okay, that's interesting now. And you look at the valuation it's at, you're like, okay, that's quite interesting. So I look at this one and go, yeah, it's a little bit bad, but PayPal's still pretty much moving all in the right directions. It's obviously got a lot of adjustment going on, and then you start going, okay, well, what kind of valuations is it trading at now? You start looking here, go, okay, it's $132. When was it last $132, for example? Well, it was pretty much back at May 2020. It's very much in the complete share trend that was going up previously. Previously, before it went on an unrealistic jump, PayPal was always a solid stock. It returned, a good 20-30% a year. And now that it's back down at these prices, do I think PayPal could probably return a good 20-30% a year? That's what's quite interesting now. And you look at the sort of like historic metrics, for example, and these have all been updated now, is that you look at the, let's say total enterprise value to revenues is a 5.32. You look at the historic metrics, that's the cheapest it's been since 2018. Look at the price to sales point of view, it's the cheapest it's ever been since 2018. Let's go on total enterprise value to EBITDA, 20, it's now a 19. Let's go on normalized earnings P ratio. It is currently at 27, and that is the cheapest it has been since 2018. It could be even lower. I just haven't got the data up past there. It just makes it hard for you guys to see it. That's why, you look at all these metrics now, and a lot of the metrics are, previously, the reason why I've always been a bit hesitant with PayPal is because even though it's dropped so much, I was like, it's dropped so much, but it doesn't, just because it's dropped, it doesn't mean it's now cheap. But we're getting to the point now where it's starting to drop so much that you look at a lot of the historic values that you're going, okay, now it's cheap. You're starting to look at a lot of the metrics and you start going, now it's at the cheapest metrics it's been since so and so, or it's been forever. We're starting to get to that point now, and that's what the difference is. PayPal's been dropping over the last few months, and it's starting to get really tempting to buy this one. It's a great company, it is on a good dip, but you're still paying a fair value for it. And I think the difference is with this earnings report is that sure, it deserved a drop, but I believe this drop is one of those drops that maybe has pushed it now to a bit of a overreaction, has now pushed it to a lot of a cheaper valuation that it should be. And I think that's the big point where PayPal could be entering now. So PayPal was definitely an interesting one. Now we've had the good, we've had the bad. We're going to go to the ugly. Facebook. I said that normally you don't see these kind of big stocks, in earnings tanker this much. And we haven't had one for a while. And then we have PayPal. And then the light buses, none come, and then two come at once. Facebook, absolute tank in the share price. Now this is one that I own, so this is really interesting to me, and previously I've been saying that Facebook is one of my favourite companies, and it's a company that I would like to make potentially back up to one of my biggest positions. And obviously one of the best times to do that is when it's had a 20% drop. And the big thing is that people always go, oh, I'd love to buy this company if it was on a drop. And you've got to always remember, you don't get the drops without some bad news, and that's what's happened. We've got some bad news, and you've got to assess, okay, what does that mean for the company? Is it time to go buy a good company at decent valuations? And for Facebook, this is basically, once again, another company that's going to have about a year and a half of share price gains totally wiped off the share price. Now, one big error that I always see with Facebook is generally, I know when I do this video, I'm going to get negative comments about Facebook. It is quite a company that has a bit of a negative following. It's just one of those stocks, I guess. But the big mistake that I always see people make with Facebook is they always call it like a growth stock. And I do that sometimes, to be fair. I'm guilty of that. But the thing is, you've always got to put Facebook in basically a value stock. This is 23 times earnings. When it opens up, it's going to drop down even more than that. And this is the thing, we're not talking about a stock here that's trading at 100 times earnings or 60 times earnings. This is about the market average here. And then you've got to look at what the company's doing and go, is this your average company? And that's the big thing that I always think you have to look at Facebook, which is really important. So when the numbers came out, revenue rose 20%, which was obviously really good. The costs were a little bit more expensive, and that also meant that their profit was down a little bit, which was a little bit of a miss. The daily active users was, same again, weren't too bad. So once again, I saw all these numbers and I was like, okay, they're not, absolutely amazing. There's going to probably be a share price drop in this. And I thought, okay, I'm probably expecting about a 5% drop on this one. And then I saw the share price down 20%. I was like, whoa. And then I was like, what has happened here? And originally, like I said, I didn't know what was going on. And then I looked at the guidance, and the guidance was a really interesting point. So this is basically these three lines here is what's caused a lot of the big drop in Facebook. It's guiding for its first quarter revenue of 27 billion to 29 billion. So this is going to be a 3% to 11% growth year over year. Now that is a massive drop off, and also that is a very wide range. You don't normally see a range that is that wide. So that says to me that Facebook at the moment are even themselves very unsure how this is going to look in 2022 for the company. When you are kind of nearly a 10% range of guidance for the first quarter, and let's not forget we are in February. We've had a month basically to kind of get how it's going to go. We're 1 out of 3 months done, and even with 1 or 3 months done, they're still giving that much of a range of guidance, and that is the big thing. And the thing is as well, is the guidance is quite low. When we go and look at Facebook, for example, their current year is 18% on analyst expectations. And once again, if they did 18%, this is fantastic for this sort of valuation. But obviously at the moment it's not. They're guiding around 3 to 11%. So this is way off what we were expecting, and it's a big range. I mean, this is the big spooky thing, is that if Facebook did grow 3%, that's where the worry is. If we grew at 11%, then it's not too bad. That's the big thing. And that's the big uncertainty that we have right now. Facebook as a company is still, once again, massive amounts of profit, revenue still growing in the right direction. Financial health-wise, once again, a very, very sound business. And like I said previously, if we just go on the historic valuations, a bit like a PayPal, until... let's say yesterday, a lot of these metrics were pretty much in line with what it's done previously. It's not exactly standing out as cheap right now, but with this drop, it is going to push a lot of these metrics down. But the thing is, well, like I said, Facebook has never been like a PayPal. PayPal's always been valued at, say 30, 40 times earnings. It's always had a bit of a heavy price tag on it. You've always got to remember that Facebook has never had that. Facebook has always been, pretty much your average valuation, which is slightly different. And even right now, it's going to be trading at a value stock. So you've got to remember, even if this company grows at, let's say 11%, Facebook at this sort of valuation for a company growing at 11% still isn't too bad, which is important. The only problem is that if they do grow at very low single digits, and we've gone previously from growing at 20%, that is where the problem is. So Facebook earnings were terrible because of this guidance, more than anything. And I guess this is the big tricky thing for me as an investor. I own shares, and normally when I see something like this, I would probably be, rushing to, buy up a lot of shares. But my only problem is looking at this and going, even Facebook themselves are struggling to guide at what they're going to do, and that makes it even harder for me to, decide what I want to do with Facebook. Because if this company was still doing double-digit growth, this drop is easy. This is, lower the boat. The problem is that if Facebook do come in at the lower end of the guidance, then you're like, oh, okay, this is going to be a really bumpy ride, and the shares could go on a bit of a roller coaster this year. And what's 22? If this is the guidance range for like the first quarter, imagine trying to predict what 2022 is going to be. It's impossible. And this is the thing, is that this is the tricky thing with Facebook right now. If Facebook do come in with strong growth, double-digit growth this year, this drop is something that is a really good buying opportunity. The only problem is weighing up, okay, what happens if they do come in 3, 4, 5% this year? And historically, Facebook's grown, nearly 20% every year. Then that's when you have the problem. And that's why it's very difficult at the moment deciding what to do with Facebook, because it's still going to be great. It's still a good company. I think it would still be good in the long term. It's just kind of assessing how much of a bumpy ride this could be in the future, over the next kind of 12 months. And if this pain could continue, because you've got everyone thinking, oh, this company was going to grow 20% down to 3%. That's going to shake a lot of investors out. So Facebook is definitely the ugly one, because the guidance was massively away from what we were expecting. So this is one that I'm having a little bit of a think on myself, because there's a lot of things that you have to weigh up with this one. So yeah, we'll see what happens with Facebook. But I would say that, yeah, this was definitely the worst one, and that guidance was definitely a massive surprise. And also, like I said just a few minutes ago, is that this kind of sums up how for us to kind of predict where we think Facebook's going to go in, when even management can't even give that much of an idea. It's quite tricky at the moment. So yeah, not much more I can add on that one, because I'm still unsure myself. So yeah, but there's the good, there's the bad, there's the ugly. I hope you enjoyed the video. Let me know if you're picking up any of these 3 stocks yourself, and hit the like button if you're new, subscribe, and I'll see you next video.